Hello everyone, thanks for checking out my video. Before I move on, just wanted to share that there will not be any of my usual weekly market analysis video for the next 2 to 3 weekends. In other words, the next market analysis video will likely be out on 2nd June. I will see if I can squeeze out one video on options wheel strategy or not. Alright, back to business. We have put behind another huge week with FOMC meeting out of the way. Powell had his speech, Apple and Amazon had their earnings announced, and jobs report reported. All three major indexes ended the week in the green zone as a weaker than expected jobs report revived hope that the Fed could cut interest rates soon. That said, the expectation for rate cut has fallen from 6 cuts this year to 1 to 2. If the interest rate remains this high, and with the US economy starting to show signs of slowing down, we could be in a period of stagflation. Anyway, let's delve deeper into some of these things, and as usual, do stay throughout the video to find out more. Alright, as usual, starting things off by recapping the key events last week. I am gonna put aside Apple and Amazon's earnings and just focus on the Fed, interest rate and jobs report, because this information are critical in the next 1 or 2 months as earnings season comes to an end in a couple of weeks time. So last week the Federal Reserve held its ground on interest rates. In other words, they decided not to raise or cut interest rates as they continue their battle with inflation, which has proven to be quite sticky recently. This is the 6th meeting in a row that the Fed has left interest rates unchanged, and this decision was in line with market expectation. But there are some changes to the future expectations. Let's break that down. But before that, very quickly, let's summarize the key takeaways from Powell's press conference. First of all, Powell said that the next move for the Fed is unlikely to be an interest rate hike. That's dovish. However, Powell also mentioned that the Fed does not think it will be appropriate to reduce the rate until it has gained greater confidence that inflation is moving sustainably towards their target of 2%. Powell then went on to share that the Fed would not act on just 1 or 2 months of data, but a full quarter was more significant, in which he acknowledged that the most recent quarter has shown that inflation is still hot and further progress in bringing it down is not assured and the path forward is uncertain. That's his words, and that's hawkish. But then, Powell also announced that the Fed will slow the pace of quantitative tightening starting in June by slowing the speed of its balance sheet drawdown to ensure it does not create undue stress in financial markets, and this is dovish. Finally, and interestingly, Powell said he doesn't really know where stagflation talks are coming from. Well, more on this later in the End Thoughts segment. Anyway, after Jerome Powell's press conference, the market expectation for rate cuts was just 1 cut in 2024 and likely to happen in November. That was the very first time we have seen rate cuts push all the way back to November 2024. But then came Friday, a weaker than expected jobs report gave investors hope that the Fed will start cutting interest rates in the months ahead. It's funny how expectations can change in just one day. So, the latest job report shows that US non-farm payrolls rose by 175,000 last month, which is the lowest since October 2023. This figure is much below the expectation of 240,000. More importantly, the wage growth has slowed down, increasing at a rate of 3.9%, which is the lowest since June 2021. To add on, the US unemployment rate rose by 0.1% to 3.9%. The market rebounded off this report with S&P 500 and Dow Jones jumping more than 1% last Friday, and the tech-heavy Nasdaq popped close to 2%. Okay, in case you wonder why did the stock market bounce when the labor market is showing signs of weakness, let me explain in simple terms for you. In a nutshell, slow job and wage growth means a slowing economy as people tighten their pockets and spend less. When people spend less, there is a chance for inflation to fall. And when inflation starts falling, it means the Fed can cut the interest rates sooner rather than later, and that is what the market wants. Alright, looking at the week ahead, earnings season is starting to ease up a little bit and the economic calendar looks light as well. This means there is a lower risk of a huge market movement this week. Some notable companies that are reporting their earnings this week include Palantir, Disney, Uber, Holdings, and Shopify. On the economic data front, we have initial jobless claims coming up on Thursday, which could shed more light on the health of the current labour market after last week's job report. Then on Friday, investors will be able to get some sensing of the current consumer sentiment and confidence levels of the US economy and inflation. Moving over to the technical analysis section, starting things off with SPY again. SPY is looking slightly bullish, but it is also sitting at a pivotal point. First of all, let's talk about the bullish signals. SPY has been testing this green dotted uptrend channel line since mid-April, and it finally rebounded off it last Friday. On top of that, the MACD had a bullish crossover. These are the two positive signs. But for the bullish momentum to continue, watch for two other things. Firstly, it has to stay above this 23.6 Fibonacci level and the 50 moving average, both sitting at around 511. If the next two candles can close above it, the bullish wave could carry on, because when this happens, it means SPY is back to this consolidation area between 511 and 524. For SPY to retest or create a new all-time high, it needs to break out of this Ichimoku cloud at around 518. If it can do that, I personally think the next target would be the new record high. On the other hand, if SPY falls below 511, don't worry yet. It may just want to retest the uptrend channel line again. It is only when SPY falls back into the channel, then we can say that the bullish momentum is fading away. In my opinion, if the retracement is just a breather to bring the market higher, then by right, SPY should bounce off the 38.2 Fibonacci level at 501. If it doesn't, then pay special attention to the level 495, because that is where the next Fibonacci level and the 100 moving average converge. Below this level, it simply means bearish. Let's move over to Apple's chart. Apple had a huge gap up after it reported its earnings. Honestly, I am not too convinced by both the surge in share price and its earnings. Their revenue and iPhone sales have declined quite a fair bit. But yet, the stock jumped, mainly because they announced a huge stock buyback plan. To me, this move is not just buying back shares, they are also buying time. I don't know about you, it looks like they are throwing a smoke grenade by using a stock buyback plan and raising their dividends to cover the significant drop in revenue. Anyway, Apple is at this point of heavy resistance. As you can see on the chart, the gap up has brought Apple right to the critical 61.8 Fibonacci level. This area is also very close to the long-term blue dotted downtrend line. If I were to give it a range, it's between 185 and 187. And last Friday's price movement has shown a rejection by the Fibonacci resistance level as the share price opened above that level and ended the day below it. Come this week, if the rejection continues or the earlier bearish momentum returns, don't be surprised if Apple gets brought down to the gap area between 173 to 182. Okay, I know it's a huge gap, but just to share, market makers may not fill the gap entirely. So if Apple starts falling into the gap this week, I would wait and watch and not do anything just to see where the market wants to bring Apple to, because you really don't know how much of the gap the market makers want to fill. Some potential levels for a bounce would be the 200 moving average at around 181 and the 50 moving average at 172. If we reach the latter level, it means the gap has been filled, and it has to bounce from there, because if it doesn't, then Apple is very bearish. On the other hand, if Apple bounces from any of the two moving averages that I mentioned, then that's a good sign that it is trying to break free from this long-term downtrend. But I would only be convinced that the bulls are in control if Apple can get above the blue dotted downtrend line. Hopping over to Tesla. Tesla is looking bullish with two gap ups. One took place after it reported its earnings, and the other was because of the interim approval on their FSD in China. Here's when things get interesting. Remember previously I mentioned that Tesla had two bear flags, and each time it materialized, Tesla broke down, and here's a potential good news for the bulls. Note the word potential because it is not confirmed yet. Basically, on the chart, it appears to me that a potential bull flag is forming. I think you should be able to interpret that bull flag is an opposite of bear flag. So, if the bull flag is confirmed, then Tesla could hit 200 in the next few weeks. But how do we look for confirmation of this bull flag? Very simple and straightforward. Basically, Tesla has to break out and above this flag, marked by the green dotted lines, just like how it broke below the previous two bear flags. Apart from this flag, watch for the level 180. I mean, as you can see, the candlesticks have lined up so nicely at this level over the last 3 trading days. This simply means the bulls and the bears are having a little bit of a tug of war here, and it also shows how important this level is to both the bulls and the bears. That said, don't be surprised if we fall below 180 by a little bit and start feeling that gap between 172 to 176. When that happens, don't need to be worried because we are still in this flag. But do be on high alert if we don't bounce from 172 because this is the bottom of the gap where the 50 moving average sits and where the 50% Fibonacci level is. Just to add on, below 172, it means Tesla has fallen below the flag, and as a result, the bull flag will be invalidated. And when that happens, there is then a high chance that the gap between 147 to 157 will act as a magnet to pull the share price further down. Let's now hop over to Google's chart. To be honest with you, I thought Google would retest 174 last week, but well, it didn't as the market makers wanted to fill the huge gap below. But like what I shared earlier under the Apple segment, market makers may not fill the gap completely and make it so nice for you to trade. Here's something very interesting. Can you see that doji candlestick appeared last Friday? That's called a dragonfly doji. It means amid a pullback, buyers were able to absorb the selling pressure and push the price back up by the end of the trading session. That's a positive sign. On top of this, it actually bounced off the first Fibonacci support level of 164. In fact, the bulls have been defending this level quite well for almost the entire of last week. Anyway, for confirmation of the doji candlestick, Monday's closing price has to be higher than last Friday's closing price, which was 167.24. Just to add, the stronger the rally on the day following the bullish dragonfly, the more reliable the reversal is. So if a reversal is confirmed, then we can expect Google to test the top end of this uptrend channel, which means we will see 170's range again. On the other hand, if Google closes below the dragonfly doji on Monday or Tuesday, then I think there is a high chance for the price to continue to fall to the bottom of the channel, basically to fill the gap completely, and this also means we will be seeing 150's range again. At 150's range, pay special attention to the 38.2 Fibonacci level at around 158. Below this level, Google is looking bearish as the next target could be the 50 moving average at 150. Not financial advice, but anything below 155 will get me excited and I will consider either snapping up some shares or sell cash secure put. Let's now check out Meta's chart. Actually, Meta looks pretty straightforward to me. It's either it fills the gap at the top or it fills the gap at the bottom. End of story. Okay, I'm just kidding. It appears to me that Meta is also at a pivotal level as it attempts to break above the resistance level of 452. Watch this level carefully. If we can have 2 solid green candles above this level, then I think it is quite likely that Meta can fill the gap at the top, which ranges from 454 to 484. That's one big gap to be filled. But I think some form of resistance should come in at around 482. This level used to be a support and now it has turned into a resistance level. So in short, on the upside, watch 452 and 482 for potential rejection. Above both levels, it means Meta is back to this consolidation area and it can go as high as 500 again. On the downside, it seems like the bulls have been protecting the 420s range quite well, as you can see that the bears were unable to bring Meta below the 420s range after the earnings gap down. In short, if 420 breaks, then I think it's about time for Meta to fill the gap at the bottom, which ranges from 400 to 414. I will quite likely pick up some shares here, if it ever falls back to this level. Okay, let's now look at Microsoft. I tell you, Microsoft is a beast. I mean, it is the most valuable listed US company right now, so it's going to be tough to bring Microsoft down. And just like Meta, the chart is pretty straightforward. In a nutshell, Microsoft is trading sideways since the start of the year, moving between a range from 390 to 430. That's a good 3.5 months of consolidation. If you have sold cash secured puts below 390 or at 390 all this while, you will be profiting quite well. Just like this particular cash secure put that I currently hold, the strike price is 390 and it's set to expire this Friday, 10th of May. As you can see, Microsoft has bounced off this level recently whenever it touched this level. This means 390 is a decent support. Another good support to watch is the 398 level. Again, as you can see from the chart, Microsoft has bounced off this level on at least 4 occasions. Okay, so in summary, if bears want to gain control, they have to take out 398 and 390 levels. And if the bulls want to have the upper hand, it has to break above this consolidation zone, which means above 430. Otherwise, Microsoft is going nowhere, and when my current put expires, I may look at selling another cash secure put. Again, this is not financial advice, okay? Moving over to the options trading section. So last Monday, 29 April, I did a quick scalp on Tesla's option as the market reacted to the news of Elon Musk visiting China, where Tesla got a tentative approval on their full self-driving, aka FSD. Basically, when the news came out, Tesla popped 7 to 10% during pre-market. Note, it was during pre-market. And that was when I knew the share price will be very volatile when the market opens. In case you are not aware, the market is typically very volatile during the first 30 minutes to an hour when it opens. So add this opening hours of volatility to that positive news, and plus we all know how volatile Tesla is as a stock, I knew the first 30 minutes when the market opens would be a fantastic opportunity for trading. So what I did was to quickly sell a cover call within 10 minutes when the market opened, and I received a premium of $9. The strike price was $200 and was set to expire on 7 June. When I made this trade, Tesla has already gapped up from the last closing price of 168 to 188.7. And as mentioned, the share price will usually move quite wildly up and down during the first 30 minutes. Therefore, I knew Tesla will retrace or decline. And true enough, Tesla dropped, and I quickly placed an order of $750 to buy back the contract that I sold. Shortly after I placed that order, Tesla fell from 188 to 185.5 and my order was filled. As a result, I earned the difference in the premiums, which is $150 or $150. The whole process took around 20 minutes, as you can see from the timestamp. Well, $150 of pocket money in less than half an hour, not too shabby, right? Okay, but that being said, I don't want to only paint a rosy picture for viewers. Do note that day trading or scalping through options is very risky. I repeat, it's a very dangerous activity because a wrong move could potentially wipe out your account. So you have to be equipped with some level of knowledge of options and technical analysis before doing it. The reason why I am sharing this trade because I think there may still be viewers who could benefit from my thought process. Alright, next up, guess what? Right after I took profits from that trade, I sold a brand new cover call with the exact same strike price of $200, same expiration date on 7 June 2024, and received the same premium of $9 or $900 because one contract equals to 100 shares. But this particular trade is not meant for scalping. Well, if you have been following me, you would have known that very recently, I got assigned with 100 shares of Tesla at $200 per share. For more information about this assignment, please check out the video linked at the top. So this cover call was an easy trade to execute because come 7 June, if Tesla closes above $200, I am okay to allow these 100 shares to get caught away at the same price that I have been assigned, which is $200 per share. To me, it's like the market makers park 100 Tesla shares with me for 1 to 2 months, and in return, they pay me $900 of rental, which is the premium. And just to add, before I got assigned with the 100 shares, I sold a cash secured put, and the net premium was $425. So in total, my net gain would be $1,325 if these 100 Tesla shares get caught away on 7 June. On the other hand, even if they don't get caught away, I still get to keep all the premiums, while at the same time I also get to hold on to my shares, which is okay since I am a long-term Tesla bull. Just to add, if you have been a long-term viewer of this channel, you would know that I love trading overreactions. And the market had obviously overreacted to the news from China, and I knew that the 15% jump in a single day is not sustainable. I believe Tesla will retrace back. And it did. It basically retraced over the next few days, and this trade is currently sitting on a nice profit. Anyway, regardless of the outcome, whether my Tesla shares get caught away or not, it's a winning trade for me, and this entire process is called options wheel strategy. If you don't know what this is, do check out my video linked at the top. Alright, if you found this video useful so far or like my free content, do consider supporting this channel, which can be done through various ways. You can either buy me a super thanks on YouTube, a cup of coffee on Ko-Fi, or just like, share, subscribe and comment something below. I would be really grateful for any kind of support. Okay, moving on, the next trade to update is another cover call on Tesla. The strike price was $200 and the expiration date was last Friday, 3rd May. This contract was sold on 26 March 2024. So what happened on that day was that Elon Musk announced Tesla would offer a 1-month free trial of their full self-driving system to its car owners. As a result, Tesla popped and gapped up when the market opened. Once again, it was clearly an overreaction by the market as the stock jumped more than 6.5% at one point that day. I knew such a rise is not sustainable and Tesla will fall back down. For more information about this trade, you can click on the link at the top. Anyway, I think I was quite lucky as I kind of picked the top for the near-term trend as Tesla went to a high of 184 that day, and then it started plummeting to as low as 139 in the next 1 month. As of last Friday, Tesla closed below my strike price of $200 and my contract expired worthless. So I got to keep the full premium of $600 without having to close my position. Okay, some end thoughts before you hear from me again in a few weeks' time. Well, so far, apart from Meta, the other magnificent 7 stocks have jumped after they reported their earnings, even when some of their earnings weren't that great, for example Tesla and Apple. All this post-earnings surge in share prices is definitely positive for the broader market, as we all know that in the last 12 months or so, the market rally has been driven by these mega cap companies. Right now, out of the Max 7, we are only left with Nvidia who hasn't reported their earnings, which they will do so on 22nd May. Watch this very closely because their earnings will likely create a ripple effect amongst the semiconductor and AI related companies. If Nvidia earnings and forecasts show massive growth, then those other companies that I mentioned could potentially rise also. But as mentioned in my last video, the earnings season will come to an end towards the end of this month. That's when the Federal Reserve's interest rate policy will likely dictate the market mood and movement again. After the latest weaker than expected jobs report, the expectation for rate cuts has risen from 1 cut to 2 cuts this year. But to me, this is all speculation. That being said, unfortunately, we have to move along with this sort of speculation because that's how the market will move. But in reality, the meeting by meeting approach from the Fed remains. They will still be very data dependent. And I believe even Jerome Powell himself is unclear how long it will take for rate cuts to begin. Speaking of Jerome Powell and the Fed's expectation, just to share, the FOMC members had forecasted 3 rate cuts this year during the meeting in March. And the next meeting where we will see an update on the Fed's forecast would be next month, during the 11 to 12 June meeting, and that will likely shake things up a little bit. Lastly, I just wanted to circle back to Powell downplaying the stagflation concerns. In case you don't know, stagflation means high inflation combined with slow economy growth and high unemployment. I personally am of the view that we cannot rule out the possibility of a stagflation completely. I mean, the latest US GDP growth has fallen from 3.4% to 1.6%, and PCE inflation has jumped for 2 straight months. To add on, the ISM manufacturing PMI index dropped to 49.2 in April from 50.3 in March, missing expectations of 50. In simple terms, it means US manufacturing is in contraction. Not just that, the input costs have increased sharply, adding more inflationary pressure to the US economy. Higher prices for oil and metals were mentioned in particular. So, sharply rising input costs with stagnating growth, that's a stagflation signal. And oh, in case you wonder why is stagflation bad, alright, to quote Investopedia, stagflation is a combination of 3 negatives: slow economic growth, higher than normal unemployment, and expensive cost of living. Whichever way you look at it, that situation is going to be painful. To add on, this is not only an extremely uncomfortable environment to live in, but also quite tricky for governments to fix. With no easy cure, stagflation can drag on for years, causing heavy damage to the economy. And just a fact for you, the last time when US economy went into stagflation was in the 1970s. Okay, with all that being said, once again, quick disclaimer, I am not here to spread fear. I am just highlighting the possibility of what may happen so that investors do not get shocked of their lives when the worst happens. If it doesn't happen, great, let the market rally continues and let our long-term portfolio be green as ever. Alright, that's all for this video. I will see you in the next one in a couple of weeks time. Till then, invest safe, alright? I will be back. And don't forget to hit the like and subscribe buttons if you haven't. Thank you.